Greg McBride is a senior analyst with Bankrate.com. Greg, great to see you as always.
Thank you, Jerry.
Let's start with the rate cut because those were the big headlines this week. Who are the winners and who are the losers? Let's start with the winners.
The biggest beneficiaries are going to be the many homeowners that have an adjustable rate mortgage due to reset in 2008 and beyond. And in particular, the prime borrowers, people with good credit that were not covered by the Treasury's foreclosure relief plan, with the fact that Treasury yields have dropped so sharply in the past few months on the back of these Fed rate cuts. Those payment increases are going to be much more manageable.
How manageable, though? How much money will it mean?
For somebody with a $200,000 loan balance that's resetting from a start rate of 4.5%, say, the payment increase is about $140 a month instead of what would have been $370 a month just a few months ago. So
that's a very big deal.
That's a gap that many households can close. You cut back on discretionary expenses, maybe pick up some overtime, but $370 is way too much.
I want to talk to you tonight about the Fed funds rate. Is it going to help you if you already have an adjustable rate mortgage and that mortgage is about to reset? Will it help the real estate problem out there for those people now that the feds are lowering the Fed funds rate? I don't think so. In fact, let me tell you why. Please listen very carefully. 3 years ago or so, when many of you got these adjustable rate mortgages, the Fed funds rate was at 1%. When the Fed funds rate was at 1%, this is how they set the interest rate. 1% plus 3 always equals what's known as the prime rate. So when the Fed funds rate was at 1, the prime rate was at 4. In adjustable rate mortgage, the interest rate on one is always 1, 2, or 3% above what the prime rate happens to be. Okay, you got a prime of 4 3 years ago. And if you had equity in the home or you had a good FICO score, maybe your first interest on an adjustable rate mortgage was 4.5%, 5%. Now we're about to readjust 3 years later. Here we are. Let's let's say the feds go all the way down to 4%. 4% Fed funds rate plus 3% brings you to 7% prime. 1, 2, or 3% above prime is what your mortgages readjust to. So it's possible that you're going to go from a 4.5% interest rate 3 years ago all the way up to an 8% interest rate now, maybe a 7% interest rate if they continue to go down. Is that going to help you that much? No, you're still having a large increase. So for those of you who have been in trouble, because why? You got an adjustable rate mortgage, it's about to reset or it has reset. Is the decrease of the Fed funds rate helping you really at all? Not really, because you're still having such a dramatic increase.